opened.
So guys, remember Uwem that took the operations class? Hey everyone.
Yes, ma'am.
Yes, he took the operations class, I think fund manager for Ingressive. Yeah, funds, yeah, director of funds for Ingressive Capital. So he's the one taking your session today. Like I told you, I think I've told you this several times, Ingressive Capital is a VC firm. They recently got a $10 million fund, so you should really listen. This is their director facilitating this class.
Yes, ma'am.
So if you have questions on funding and all of that, this is the right class for you. Anything about how to raise money, valuations, the seed round, what is the seed round, what is Series A, Series B, everything you need to know about that is basically in this class. And this is our last class for this program. So yes.
Okay.
Good morning, everyone.
Good morning, sir.
So I'm just having a bit of problem sharing my screen. I just realized I have 1,000,001 documents open. And so just give me about 30 seconds to get this right.
Hey, good morning, sir.
Sorry.
Okay, I think I'm almost there. Okay, I think. Oh, no. Okay, do you see my screen now?
Yes, sir.
Okay, all right. How's everybody? Hope everybody's okay. Hope everybody's staying safe. Hope everybody's staying healthy. I mean, health is wealth, or health is wealth, and it's very important to take care of yourself first. If you're suffering health-wise, your business would probably suffer.
Definitely suffer.
Yeah. So there is a lot today to talk about. So I'll try to be as fast as possible so that I can cover everything. Today we'll be talking on the fundamentals, on equity and funding. But I'm going to start with funding first before I talk about equity. So the very first thing we need to note is that cash is king. No matter how big a business looks, you're only as good as how much money you have at your disposal. So if your money is tied up in agreements or assets that cannot become liquid, you're as good as you're poor. Cash is what makes businesses survive. Especially during this period of the pandemic, you'll find out that the companies that are surviving are those that have money to spend.
Yep.
Cash flow is a major factor for long-term success. So, like I said earlier, you need money to keep on building and iterating and exploring the market and carrying out any other business activity that you need to succeed. I'm quite sure that some of these things have been covered, but I thought that I should just quickly touch on them. I mean, there are different forms of funding. You can bootstrap. I know a lot of you already know what bootstrapping is. Taking your savings, taking that hustle money, and using it to run or invest in your business. You can go through FFF, your friend, family, and fools, people that believe in you, or people that are open to just giving you money to invest in your business. And these are some of the safest ways to finance your business or your business activities. And then there are the bank loans, which are not, first of all, not everybody can access bank loans, and they're not even advisable depending on the stage of your business. Because especially in Nigeria, they come with exorbitant interest rates. Even with CBN's intervention, the interest rates are still insane. Then there are venture capital companies like Ingressive Capital that basically. How many of you know the difference between angel investors and venture capital companies? Okay, so no answer. Basically, angel investors invest their own money, their personal savings, their own cash. Venture capital companies invest assets under management or money under management or other people's money from limited partners into your business. So while they basically do the same thing, the financing works quite differently. And I put business incubators asterisks in. I mean, business incubators and accelerators in asterisks because they are beginning to play in that angel and venture space quite a lot. While after they've incubated you and giving you those business development services, they tend to want to own equity in your business. They tend to also want to invest some funds. So hybrids are beginning to emerge over time. Like your Y Combinator. Your Y Combinator is a venture capital company, but they do way more than just invest money. They go as far as acting as an incubator for a short while for your business. And then there's crowdfunding, which a lot of you know, where you get a bunch of people to invest in your business because they believe in your vision. And most times, oftentimes, they're not necessarily getting much of a monetary benefit out of it. Most times it's that they believe in what you do. Although crowdfunding has morphed over time to include perks. So if you invest in my company, you get to receive this, And then there are the government grants and subsidies that are really available, but access to them is always based on how much information you know about them, and sometimes who you know there. But yeah, there are government grants and subsidies that are available that people can take advantage of. If you're into agriculture, there's NESAL, there are many. So it's important to note that not all funding sources are for existing businesses. So if you've not kicked up your business, if you're not validating your hypothesis, if you don't have an MVP, you probably will struggle to gain funding for your business. Funding is always given to interesting businesses, whether it's an idea or it's already an existing business. It has to be interesting. Nobody gives you money for nothing, right? Nobody gives you money for something bland. You have to find a way, and that's why we tell people you need to learn to pitch your business or sell the best parts of your business or build your business in such a way that is very interesting to other people. And then not all available money is good money. Because you have access to money, because somebody says he wants to invest in you, does not mean that money is good for you. You must learn to decide which works for you. Does this person align with your values? Would this person invest in you and try to control the company? Would look beyond the money. What else is this person bringing apart from money? Because oftentimes money blinds our eyes to a lot of things that are important. So before you even apply for any source of funding, be it a venture capital company, be it an angel investor, be it a grant or subsidy, you need to ask yourself various questions. The first one is, why do I even need this? Do I really need to raise money at this point in time? Can I just bootstrap? Decide on which type of funding is right for you, because different types of funding are relevant for different stages of your startup growth or your startup journey. So which one is relevant for you? Do you even qualify for it? Don't be like people that are applying for every grant, just keep on applying, and spend all their money applying, all their time applying for funding. When did you even check the eligibility criteria? Did they even fit into that company's philosophy? Is the company looking for a company like yours? If your company is an e-commerce based platform or a startup, and you're going to apply to an angel investor that funds agriculture, you definitely not get funding. It's not about prayer. It's not people from your village. You're not just reading or checking the eligibility criteria. Do you have all your documents, all the things that you need to back up your application? Do you have a business plan or at least a business model canvas? I recently did a book on how you can visualize your business using a business model canvas. I probably will share the link some other time. And then understand the different types of funding sources and be clear on what the funds will be used for. So what exactly are you going to use these funds for? After you've gotten, okay, you say you need 10 million naira to run your business, and a benevolent high net worth individual gives you that 10 million naira, what are you going to use the money for? Are you just going to be like some people we had? I mean, well, I don't know if I should mention names, but how many of you know of High TV and what exactly happened to that business over time?
Yes.
Do you want to be in that kind of category where you raise money and then you're living the best life?
Yes, sir.
Instead of your business living its best life, you are living a personal best life. Then okay, that there's a typo there, but what other benefit is the investor bringing? Like I said earlier, it's more than just money. There is more to running your business than just access to finance. What else is the investor bringing? Do you know your numbers? Like, do you know what is the difference between your profits, your revenues? Do you know how your cash flow looks? Do you have income statements? We need to standardize your business right from the foundation, because you need all these things if you're going to become a very serious business. A lot of business practices you enact at the beginning of your business, at the foundational stages of your business, will affect how far you go. That's why you see, that's why I feel like you don't have generational businesses in Nigeria or even on the African continent. Because if you go to the company and say, hey, who remembers Leventis? My grandfather died a couple of years ago, and we found the man actually owned a lot of shares in Leventis, but their result, they're nothing, they're useless. Why? Because these businesses did not put the foundational, they didn't put their foundations right, they didn't build it on good foundations, such that when the owners died, or when the owners moved on, the companies died because no structure.
Mm-hmm.
Know your capacity for collateral. If you're going to get a loan, can you pay it back? Like, it doesn't make sense to go get a loan on your parents' properties when you know you cannot pay it back and everybody will end up losing. Then understand what the funding source will cost you. No money is free money. No benevolence is free, in quotes. It will cost you something. And so you find out what the different investors are offering. What are the interest rates? What are the things you will have to let go? You need to look at this thing holistically. Don't chase the money without looking at the implications of getting that money. Then research your options, and then more importantly, build a great team and quality relationships. I tell a lot of people that the people that end up raising money are people that have built relationships over time. Because a venture capitalist or an investor says no today does not mean he'll say no tomorrow. It's all it's all based on relationship. And another thing I learned over time is that referral is so important in the business world. You find out that a lot of high net worth individuals, a lot of gatekeepers in quotes, a lot of people that make the decisions only act based on referrals, because they don't know everything. So they to listen to their advice. So you need to build quality relationships. So what exactly, I'm sure you guys have probably done this. So I'm just going to gloss through this. The reason why because it's actually important in asking for funding, or trying to seek out funding. Is your business full at all? Is it unique? Is it innovative? Is there an opportunity in the market? Right? Yes, you might be your business is innovative, is first of its kind, is in a blue ocean, right? But is there an opportunity in the market where people actually buy this thing if you launch it? Do you have basic financial understanding? Is it scalable? Can you move it from Lagos to Abuja and will it succeed? Okay, let me make it better. Is it scalable across similar markets? Do you have leadership and entrepreneurial skills? Last week I was talking to a group of entrepreneurs. No, actually a group of investors, and we're having we're having back and forth. And one thing was very, very clear. VCs don't necessarily invest in the business. They invest in the person leading the business. Yes, your business looks interesting, but it is you they're investing in, because you are the one that will drive that business. Oh yeah, now I now remember the conversation. So it was actually a shareholders meeting, and so the founder wanted to float a new business, and everybody, 80% of the investors kicked against it. Why? The common denominator was, hey, we invested in you, right? And we invested, it was through you, we invested in this business. If your mind is divided, you probably will not grow this business as much as you ought to, right? So we are saying focus on the core, on why we invested in you. Don't be distracted, right? So eventually you see that investors actually invest in the person and not necessarily the business that's bringing the money, because the person is the money maker. And that's why you must know your worth as an entrepreneur. And then invest in the growth potential of the business. Can it give me returns times 10? There's no investor that invests in you for nothing. The person wants something in return. Okay, if we look at it holistically, we say some people don't necessarily want money in return. They want what's the word now? It could be social. It could be a social reward in terms of, hey, I was one of the first investors in this company. It could, right? But at the end of the day, everybody wants something back. There's nothing free in life. So let's jump to the other part, equity. And this is going to be, I wouldn't say a long conversation, but it will be, it's equity. So the equity conversation is a very, it's not something you can treat in a class, right? So I'm going to try to cover as much as I can, the most important things, and I'm going to drop a link to recommended reading for you. It's a very holistic document that talks about everything funding and equity, and it is free. It's literally a book that is free online, and will give you everything, all the information you need around funding and equity. So basically, what is equity? Equity is just ownership of your company, or ownership in a company, or how much somebody owns in a company, right? And before we even go into all the conversations, I'd like to give you 4 equity rules. Number 1, treat equity like gold. Treat your ownership of a company like gold. It is very important. You need to be careful and cautious as to how much you're giving away your equity, because it is ownership of your business. If you give up too much, then the company is not yours. If you don't give any away, you probably will not grow fast enough. And I'll explain later. The mistake is entrepreneurs should change themselves in terms of funding and expertise because they don't want to dilute their equity. When I say dilute equity, I mean they don't want to reduce their ownership of their company and give other people a bit of the ownership, right? But at the end of the day, it all depends on the situation, really, where you find yourself. And look at the stage that you're in. There are some growth stage companies that the founders will say, hey, I don't need to give out equity because I'm growing, I'm making money. But at some certain stage, at the pre-seed seed stage, at the stage where a lot of you are, you need to probably give up equity to your staff, to investors, or for different reasons. So treat equity like gold. And exactly, know that equity is ownership to your company. So be careful with how you discuss equity, on how you give out equity. Second rule is the pie is fixed, but the value is variable. Because you own 2% today, it doesn't mean that your 2% will not be worth billions. How many of you have heard the story of the guy that sold off his shares to Apple many years ago that would have been worth billions by this year, or billions now in current times? So because you own 5% of a company does not mean that 5% cannot be worth 30 billion in 5 years. So you need to know that equity, the way equity plays out, even if you have more or less, it could actually be to your benefit. 100% of something that's worth nothing is nothing. On the other hand, if you own 5% of an amazing company, you'll probably be a billionaire, right? So it's always important that you at different funding rounds and when you're seeking funding, that you speak to people that have walked the path. You speak to, if you don't have access to a lawyer, reach out on social media. There's so many, okay, not so many, but there are entrepreneurs and are founders that are open to sharing their experience. There is an Asemota online, there's a Jason Drop online. There, you find the Piggyverse founder online, or you find people that are just there sharing their experience. Ask them what to do. It's always online. Ask them what to do. You cannot do this journey on your own. I always tell people, look for people, reach out to me, reach out to Mercy and ask for their experience. Now, because they tell you the experience does not mean you necessarily have to follow it, but you need people's experiences and advice to make a more balanced decision. The third rule, know which employees are motivated by equity. Now, at the beginning stage, at the pre-seed, at the early stage, you probably cannot pay for expertise. So you would be, I wouldn't use the word forced, but you would be required to give out equity. Now, there's a typical equity distribution or a standard equity. Well, it's not necessary. So the thing about equity distribution generally and breakdown is that it's by need. So typically they will tell, first of all, you cannot own 100% of your business if you're going to raise money. If you're going to employ people, okay, I'm trying to rephrase this. If you're going to have a co-founder, it is almost impossible, number one, to own 100% of your business, right? Because oftentimes you cannot pay for the expertise for a co-founder. So oftentimes you see people go 60-40, 70-30, depending on how much they think the co-founder is bringing. Now, we always tell entrepreneurs, when you're raising money from VCs, when you get to that stage where you're raising money from VCs, to have an option pool. Option pool is like standard 20% of the total equity. So 20% means that you can, out of that 20%, you can give your early employees access to that equity so that while you cannot pay them, you can give them ownership. And what people do is they vest it. I don't know how many of you have heard the term vesting.
Yes, sir.
Now, vesting is saying, hey, you have access to 5%, right, of my company. You're going to own 5%, but you must do XYZ thing to own 5%, or you must have you must have hit this milestone or stayed a length of time in my company or worked a length of time in my company to hit this milestone. So to own 5%, you must have worked for 3 years and have built this. That's vesting.
Yes,
that's just another way of protecting yourself from people that, can jump in and jump out. And we need to realize that in the business of running your business, there is the legal part. You cannot run away from the legal part. Document everything. Have standard documents. Sign things. Get a lawyer friend, even if you cannot afford a lawyer. And there are a ton of free tools you can use online, legal tools you can use online. However, be careful because what's applicable in the US might not necessarily be applicable in Nigeria. So you need to be careful. That's why I said make friends. Relationships are so important. So keep in mind that not everybody has different needs and values, right? Some people are more concerned about making money. They want the salary. Some people are about, impact. What am I giving back? So they'll be okay with equity. But it doesn't mean that you should shy away from employing the best hands. Know what motivates the people at the early stage and give it to them. Some people, it could just be that vision. I want to change Nigeria, and you get people that's all they want. They will work hard for you because they want to change Nigeria. So, know which employees are motivated by equity, know which employees are motivated by other things, and use that to your advantage. Take up equity decision seriously. Start discussing equity at the beginning. A lot of times we run away from hard conversations. But if you're working with somebody on a project, start discussing equity, because the minute money comes in, there will be war. I have seen it happen so many times. When I managed the 20 Element Entrepreneurship Program, the minute we gave out seed capital, founders were fighting. It was like clockwork. People were fighting. Give me this share of the money. I worked hard for it. Transfer X amount to my personal account. So you need to start discussing equity at the very beginning. If you have co-founders, people working hard on your project with you or your business with you, or people that are hoping to get ownership in your company, start discussing it early. Sign the document. Make it legal, because money changes a lot of things. Money changes a lot of things. And be careful, don't just throw away percentages. Give out equity based on how important the person is working on your business. Give equity based on how much you value the input of that venture capital company. At any stage, anybody, and this is the general advice I'm giving people, anybody that wants more than 12% of your business at an early stage, I think you should just walk away. And when I mean work in terms of an investor, not a co-founder or whatever, that's your own person, but I'm talking of investors. Somebody says, I'm going to give you 1 million naira, give me 20% of your business. It's not worth it. At that early stage, it is not worth it at all. And so key terms to note as we're discussing equity, dilution. So dilution basically is the decrease in ownership that occurs when you issue new shares. So say, for example, you owned 50% of your company. The minute you bring in another investor, okay, let me use a more rounded figure. If you own 100% of your company, if you bring in a new investor and give out 10% of your business, how much do you own now? You own 90%, right? So the more you bring in newer investors or you issue out shares to other people, your ownership size reduces. That's dilution. Pre-money valuation, and I'm going to really talk about pre-money valuation in the next few slides. But pre-money valuation is the valuation prior to financing. So basically, it is how much you value your company prior to taking in more money. So after all said and done, you value your company at 10 million naira. That's your pre-money valuation. If somebody is going to invest 250,000 naira in your business, your post-money valuation will now be your original 10 million naira valuation plus the 250,000 naira, right? So your post-money valuation is valuation after somebody has put in money. Now, I don't think I'm not jumping the gun. At various stages of your business, they are like ballpark valuations. So at the seed pre-seed stage, except your company is doing something insane like Terranos. I don't know how many of you have heard Terranos. Or you have the cure for cancer, right? Your valuation will not be more than 2 million or 3 million. At the pre-seed, when I mean $3 million, at the pre-seed seed stage, right? So at certain levels or growth stage, there are ballpark valuation figures. And I'm going to share a document or an article that will help you on that. So don't start your business and because you think you're the best thing after sliced bread, your valuation of the company should be $50 million, and you don't have any customer, you've not gone into the market, you're not getting any profits or revenue, then you are paying yourself. So I'm going to list out 4 valuation methods. There are about 10. There are different ways, but I'm going to talk about 4. Now, I'm not going to be talking about numbers per se, but I'm going to tell you how people get to the numbers. The first method is called the comparison or comparable pricing method. And this is basically the simplest valuation method. Now, the caveat, for every valuation method, there are pros and cons, right? None is perfect. Depending on who you're speaking with and depending on your negotiating power, valuation, to be very honest, especially when somebody wants to invest in you, is more of a negotiation. And valuation is not necessarily based on a true figure. It's more on negotiation based on these things I'm going to tell you. So if somebody says, oh, I value your company at 2 million, you can actually say, no, I value my company at 3 million, and this is why, right? And that's why we as venture capital companies also know when you are trying to oversell yourself. You come to me and you're saying your valuation is 5 million. I say, no, give me a discount because I think your company should be valued at 4 million or 3 million. But I'm going to talk about 4 methods you can use to value your business. The comparable pricing method, which is the simplest. And it basically looks at similar companies to yours. So say, for example, your company makes 10 million naira in revenue every month. I'm going to look for a company similar to yours in Nigeria that makes 10 million naira every month in the same sector and ask them for their valuation or check their own valuation and now use their own valuation as a benchmark for yours. So say, for example, you are building a Paystack, a similar company like Paystack, and you're beginning to get their kind of numbers. I will find out how much is Paystack worth? What's their valuation now? And then I'll use that to value you. So that's the comparable price method. And that's actually one of the easiest ways to value early stage startups. Very, very easy. So you look at, so in India, a similar company is valued this. So I'm going to value your company this because India is a similar market, right? The other method is called, number 2, the scorecard method. and is used mainly by angel investors. And so they look at some various success factors, right? And then so success factors like your experience, your competition, and they look at the market. And then they try to see if those things like your experience, your team, your product is above average, is better than what is in the market, they value you higher than what is the valuation of the current products or services in the market. So it's a bit tricky, right? But the problem with this method is that sometimes people get a higher valuation than they should have. However, it's another way of valuing yourself. So things like your team strength. I was recently talking to a company that launched a startup in Nigeria, and their valuation is a bit on the high side. And why? Because this guy was one of the founding. In short, their core team is made up of founding members of a company that just raised the Series B. They left the company recently. So they are basing their valuation on their own experience and their previous exploits in other startups. So the scorecard method works for them, right? You look at, for who that built a similar product, what is their valuation? Is this product better? So if this product is better, then this valuation of this company should be higher. The third method is called the discounted cash flow method. So you think about all the future earnings of the company and then use it to value the startup. Now, this can be very tricky, and most times accountants that do that. And to be honest, this is not necessarily a true value because, say, for example, nobody saw COVID happen. So imagine valuing a company based on DCF, discounted cash flow, and then COVID happens. That means all your numbers, all your projections were waste. So while this works, it works for different stages of companies. And I would never apply a discounted cash flow method to an early stage company. I would look for companies that are into their IPOs or Series B or big companies. And this is also very accounting based. So you need an analyst and accounting that is really, 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 really good at this. And then the last method is cost to duplicate method, which is what most people typically do. So we look at how much was spent building the startup, how much was spent on the server, how much was spent per time, how much potential salary should we have spent paying the founder over time. And then we say, would we be able to afford to do the same and build a new company? If we can't, then we value this company based on all the numbers we have put together. So what is the cost of the assets, fiscal assets this startup has? How much are they paying in subscription if your company is software as a service? How much have they spent renting their office over time? And then we use that to value the company. Now, this is the easiest way to value a company because you can sit down in your house and do it. You can think, how much have I spent paying my staff? What is the cost in man hours for me since I started developing this platform, right? How much would I have paid my co-founder to design this product? All these things sum up to the value of my company. The only problem with this is that it doesn't take into account the potential for growth, future sales, returns on investment. So while this is the easiest, you're also shortchanging yourself in a way because it doesn't show your actual work. Because, like I said, valuation it's an art. It's not a science. There's no one way to go about it. It's a negotiation. So to get an actual worth of a company, you look at present cost. You also look at future earnings and potential for growth, and you blend them into one. And if you notice, all these methods that I put kind of picked on different parts for it. So there's no right way to value your company. At different stages of your growth, you use different methods to value your company. And for different investors too, you use different methods because different investors look at different things. Before we proceed, there are two important things that I'd like us to look at: undervaluing and overvaluing. And these things actually affect how far and how well you go while growing your business. The first one is undervaluing. If you undervalue your business, you're probably going to shortchange yourself and not get and sort of lose ownership of your business. and not raise as much money or get as much investment that you need to raise, right? So you need to be careful. Do not undervalue your business. If your business is worth 4 million, don't say your business is worth 500K. That means somebody will invest a higher amount and get so much ownership of your business, but you don't have enough funding to survive. On the other hand, overvaluing your business, you need to be very careful. And I see so many startups make this mistake. It's one of the reasons why we pass on so many companies. I see a company that is not making any money, no revenue, nothing. And you are pitching to me, you're telling me, I'm trying to raise 500K at a $5 million valuation. And I'm like, but you don't have any customer. How? So you're overvaluing your company, unfortunately. And the drawback to this is the minute you raise that money, if somebody thinks, okay, let me bet on this company and raise that money, you're going to struggle to raise future rounds. Because the thing about taking money from people is that it puts you under pressure to succeed. And if you don't succeed as you are promised, right, you struggle to raise more money in the future. You look bad before your investors. You put yourself under undue stress. And you end up being a frustrated founder running from pillar to post because you're trying to live up to expectation. Now, the problem with overvaluing is that you now have to devalue your company over time if you're not living up to expectation. And devaluing makes you look bad. It makes you lose more ownership of the company because your investors will lose because investors want to exit rather, and then they sell off their shares and your company now loses value. So imagine if they said, oh, your company was valued 10 million at 10 million naira. Let me use naira now. And then 2 years from now, they say your company is valued at 2 million naira. Do you think that people will want to take a bet on you that way? So you need to be very, very careful not to overvalue your company. And I see this happen every day. I remember I met a founder that started this company in 2007 rather. As at 2007, the value of his company came because it's a fintech platform, was 2007, 2017. Anyways, at that year he launched, the value of his company was $13 million. Now he's raising money and the value of his company is $7 million. The excuse is COVID, but I laughed. I said, how did your company launch and the value of your company was $13 million without any customer, nothing? You really overvalued your company at that point in time, and you have been trying to live up to that expectation ever since, and it has not worked for you. So you really need to be careful. I know everybody wants the best for their business, but you need to be careful as to how you value your company. Like I said, look at similar companies around the world like yours. Please don't compare your company to companies in Silicon Valley. Now, in Silicon Valley, you can start your business with an idea and be valued at $10 million. In Nigeria, it is unheard of because we don't have liquidity like those in Silicon Valley. The environments are different. Investment appetite is quite different, or risk appetite is quite different. So you cannot really compare. What you do is compare similar markets. So you look at Kenya, you look at an India, right? You look at a similar market and see how valuing companies in those countries, in those regions. So in closing, this is a recommended reading. I'm going to send these slides to you. It's important because it basically shows, it talks about everything funding, from when you should seek funding to, what size of tickets, what ticket size of investment should you be seeking for at different stage of your company. At seed stage, what should your valuation be and what should you be seeking for in investment? It will be different from when you are in the Series A, when you are raising money over time. In short, for different stages of your business, people invest for different reasons, right? At your pre-seed seed stage, you're basically, what are you trying to do? You're building an MVP. Okay, no, at your pre-seed stage, it's an MVP. So people are investing in an MVP, in an idea that is becoming a reality. At seed stage, you're getting investment to achieve product market fit. I know many of you have heard the term product market fit, and I expect that you know what product market fit is. Basically, it is, it basically is your product or service fit for the market or fit for the customers you have selected. Are they going to buy it without thinking twice? Then at Series A is basically your growth stage. So first of all, you have built an MVP that works. you have found product market fit or the customer segment that is going to buy from you. Now you go to Series A. Series A is now growth, is your growth stage. How do I scale and reach as many people as possible? And then you continue that way. Every additional fund.
Hello.
Yeah.
Sorry, so we lost you for about 5 minutes.
What? For real?
Yes, when you're talking about the markets, right? Why valuation and all that, why you shouldn't compare yourself to Silicon Valley. We lost you from that point. And we have some people here.
Interesting. Okay. Now I'm trying to figure out what's up. Okay.
Yeah, it was on that slide. It's on that
slide. Okay, so did you India and Nigeria? Okay, yeah. So the point was you need to be careful when comparing similar companies in different sides of the world. So the realities of Silicon Valley is quite different from. There's liquidity. There are so many people that are looking to invest there. The value of the money is different. The cost of is different compared to Nigeria. So when valuing your company, you look at similar markets. So you look at, a similar market in Africa to Nigeria would be a Kenya. You wouldn't even see a South Africa because South Africa, they have a lot of people investing. You look at the Kenya, you look at an India, they're quite similar in terms of the makeup of population, in terms of the makeup of the investors, their investment in their risk appetite, right? So you need to be very, very careful when you're valuing your company. And I said, I'm going to send these slides to you so that you can look at this link. This link contains quite a lot around funding, how much equity you should give up at different stages of your company. I mean, what the various stage of your companies mean. And I went to explain that at your pre-seed stage, where most of you are, you're basically building an MVP. So you need money to build an MVP or a prototype. At your seed stage, you're basically trying to figure out product market fit, right? Trying to see the customer segment that is willing to pay most for your service. At your Series A, which I am quite sure most of you are not in, but you'll get there one day, is basically your growth stage. So you want to grow as much as possible. So you have a product that works. You have a set of course, you have figured out the customer segments that will pay most for your service or your product. Then Series A is you want to grow as much as possible. You want to scale. And then going forward, Series B, C is just to continue scaling and increasing and dominating the market, being number one. So this article is basically a book that has been repurposed into a long article. It's a long article, but the beauty is there are headings. So the part that contains, you just click on the headings and it takes you to what you need to read. What you need clarity on basically. So that's basically it on this. That's basically it on equity and funding. But I'm open to your questions right now.
Guys.
Well, can you go back to that last slide where you have the recommended readings? Where? Hello?
Yeah. I've moved it. Yeah. Can you?
Right. Yeah, just from I'm trying to pull up the. Okay, go ahead. Guys, ask your questions.
Sir, what do you think is key in terms of balancing out the undervaluing and overvaluing in terms of your startup, especially at the pre-seed stage?
So I always tell people, number one, before you raise money or when you're thinking of raising money, do your own due diligence on whoever you're looking to raise money from. So, say an aggressive capital, we have at least 14 companies that portfolios. Reach out to the founders, and you can find some of them on social media. And ask them how much. Some of them might not want to give you some details, but they will give you a general advice. So, how is this investor? How do they value companies? What was the value of the company when you raised money? Or what do you get? Also, reach out to founders. They are, like I said earlier, they are gatekeepers or people that are experts in the industry that are everywhere on social media. It's how you approach them that matters. You find them on LinkedIn, you find them on Twitter, you find them on Instagram. Reach out and ask and tell them, okay, this is my company. This is how much I value my company. What do you think? Don't go and say, how much do you think I should value my company? Do your homework first. And valuing your company, you look at various things like the different methods I showed you. And then you look at comparable companies across the same business sectors and regions.
Okay.
Yeah.
Okay, good. And another question, sir, at Ingressive Capital, do you guys work with any pre-seed businesses?
That's
and
what we
if
play,
so,
pre-seed and seed stage.
Okay, great. Especially for pre-seed, what do you guys look out for when interviewing or considering a startup to come aboard at that stage?
Okay, so I'm going to give a general answer in the sense that this is not just relevant to Ingressive Capital, it's relevant to most investors, most venture capital.
Yes, sir.
The very first thing is we're in the age of tech, right? And your business, people need to see that tech is not necessarily the product, it's actually an enabler. So we're looking at businesses that are enabled by technology.
Yes,
Second of all, we're looking at the team. The team is so important. That's why you see some VC firms check to see if you have a co-founder, because we know that the entrepreneurial journey or the entrepreneurship journey is not easy, and you oftentimes need a support. You know that you don't have all the skills in the world, so you need somebody that is equally skilled. So we look at the makeup of the core team. Is there a technical, so if it's a tech product, is there somebody responsible for technology there? Does he have the expertise? Where has he worked in before? What is his experience? What are the experiences of the team? Are they complementary, right? So if when I mean complementary, I see that entrepreneurs make this mistake of trying to recruit people like them instead of people that bring complementary skills to the team. Yeah. We also look at if your business is scalable, can it move? Because investors want to make money, and scalability is a core part of making money down the long run. I mean, in the long run, right? So you want to see if the business is scalable in the long run. Are you targeting $1 billion market? So what's the size of the market you're trying to target? And is it even reasonable at all? Right?
Yes,
What else do we look at? We look at if you own the IP. So is the technology owned by you? If it's hardware, do you have patent to it? Because we don't want a case where we invest in you and somebody replicate. How easily replicable is your business? Because we just easily just replicate it.
Yes,
so we think you're investing in the first to market, and then tomorrow we find that somebody can copy it. Are you even the first to market? And if you're not the first to market, can you be the number one in the market over time?
In the market.
Yeah. You see how this is also tied to future earnings and future potential of your business when you're valuing your business. So we look at all those things. Then what else? Really, there are quite a number of things, but those are the general.
The general.
Now.
Okay.
Yeah.
Okay. Thank you very much, sir.
Please ask questions.
Uwem, I have a quick question for you, which is very general.
Yeah.
In Nigeria, given the limitations of data, how do you really do DD on most of these companies? And I don't know which sector you are more focused.
Okay.
But in terms of getting the data to do the DD, due diligence.
So due diligence, actually a very, 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 very interesting topic, because for most investors in Nigeria and in Africa, we are always tweaking our due diligence process because data is always hard to get. Now, unfortunately, most businesses are not built on good business foundation, so they don't always have that data. But but you cannot have blind faith when investing in people. Yes, it's good to an extent. You can have blind faith, but blind faith will get you into trouble. So we then, there are the various ways we go about it. One, we look at, so say for example, we want to invest in a fintech related platform. And when we've spoken to you, you say, oh, I worked with this guy on this project. We go look for those guys and ask about you. Well, what do they think? So we ask their opinion on you and the business you're running. So basically referrals. We look at what people say about the person. Then we also go and we actually test out the product. So if you're building a product, if you check my phone now, I have so many apps because I've spoken to so many people, but I will be foolish to want to invest in somebody and not try out the service or the product. So we actually do try out the products and the service and see how it is good. We don't necessarily tell you we're trying it because if you know we're trying it, then you're expecting you'll be expecting us and want to make it good. So we just do random spot checks. There was somebody who invested in Ghana and we actually sent on our venture partners to go try out the service. The person didn't know he was there. And we tried out their service in different places, different of their outlets. So we do that. And then we look at, we ask for your data room. And that's why we say you must know your numbers. So basically your data room has to contain your registration document. It has to contain, if you have suppliers, information on your suppliers. It has to contain your balance sheet, your financials, your projections, because as much as we look at your projection, we want to look at how well you're doing.
Okay.
Currently. So basically, how much you made last month. We look at your reports. I expect that everybody here, when you start trying to raise money, you must have your monthly reports. Monthly reports sometimes just very simple, top level information on this is how many customers we had last month. This is how much we have. This is 10% growth. This is how much we made last month. This is how much we made this year. I mean, this last month, this is how much we made this month, minus 10%. These are the reasons why, top level investor reports that you send to send out to potential investors. You must have those things in your data room.
Yeah.
What else? We also look at the legal side. So we look at how many people have invested in your business in the past. We look at your cap table as part of our due diligence. Is the cap table messy? Who is invested in the company? Are those the kind of people we want to get in bed with?
Yes, sir.
Those because you need to be careful. As investors, we know that there are some investors that are hard to work with. They they want to control the company. Do we want to be in the same boat as them? Then we look at who your lead investor is. Now, when you are raising money, there has to be a lead investor. Your lead investor is based on various things. And your lead investor oftentimes dictates terms for the other investors. So your lead investor brings in the most money and the lead investor should bring in the most expertise. So very good example. If a Kenyan company is trying to get into the Nigerian market and they're trying to raise money, a sensible thing for them to do is look for a venture capital firm to lead that round in Nigeria. You know why? It's not just because of the money, because it's a Nigerian company and they understand the nuances of doing business in Nigeria. So they'll be able to tell them, this is what to do, this is how to register your business here, these are the contacts you need to meet, right? So we part of our due diligence is looking at the lead investor. Is it worth it? Do they have the expertise to lead this company? And a lead investor also, because they want to make money, also helps in your future rounds. They shop you around to potential investors so that you can raise in the near future. So that makes part of our due diligence. And then we actually do in Investive, we have a long checklist. We kind of, part of it is there how many females? Yes, it's actually a relevant question. Do you even have a female in your team? There are quite a number of questions, but those are the basic due diligence things we look at in your business.
So a follow-up on that, and I will narrow my question. I threw the question first as an open-ended, but I will narrow it down to be more specific. Again, it's back on data. Given that access to data is difficult, when you're going to do top-line analysis and valuation of the company, and you want to know the size of the market that this company is trying to address. So how do you come about, or where do you get the data specific to this part of the world where data is very difficult to get? I would say the total addressable market is X amount. I'm a startup. I said it's worth 10 billion. And I think my obtainable market, the market that I think within that 10 billion that I could access is 10% of that.
Yeah.
Within your due diligence, how do you address that to ascertain whether the size of the market is actually 10 billion? Because we're in an environment where data is very difficult to get and to quantify. So how do you quantify the market realistically to make sure what your potential portfolio is telling you is actually that.
So one, VCs actually spend a ton of money on reports. Like we do spend money on reports because we really want to understand the market. And so every time a PwC or a McKinsey or a startup report comes out, we actually do purchase it and run through it. And because we do have insiders in some of the industries, they actually do send us stuff. So even before, like say, a CBN report that is an internal memo. So maybe that does not necessarily divulge the country's secrets, right? We do get access to some of those things. The other part way we do it is also to lean on industry experts. So there are people that have been in industry for a while that know these things at the back of their head, unfortunately not documented. So we wanted, okay, now there's radiography, a radiotherapy platform that we're looking at investing in. And we don't have, because we are experts in everything, we don't have experience in that. We don't even know the numbers behind what we do. We looked for an American investor that has been in Africa for the last years that is in the medical field. Now that guy is a trove of data. It's not written, but he has it in his head because he has done at least 15 medical related investments across Africa. So that person, if you lean on his own understanding of the markets, you probably get a more truer data from him. So we lean on who we call industry experts, people that have been doing it for years, people that do it, right? No investor knows everything. You should run away from an investor that claims he knows everything. We actually do lean on ourselves for information.
Okay, that is quite helpful. And for the purposes of this cohort, a lot of them, I believe, are in a space where they don't have data. Well, not that the data is available, but given their position, they may not be able to have access to that report because it costs, some report costs thousands of dollars to actually get PwC or KPMG or Arthur Anderson or whichever, or sorry, not Arthur Anderson, but Anderson, all those kind of data to say this is what the market size is. I have a strong worry for these guys. Sometimes they come up with numbers that are not quite realistic. And what kind of guidance do you give your portfolios in terms of what by the time that they come to you already, they have done their homework anyway. So if you are guiding them, they're already giving them the answer. But for this class, what would you advise them? Given your experience in the Nigerian space. So
first of all, do your research, right? Even if the data is not out there, there is some data. So a big part of being a startup is that you're going to be extrapolating a lot of data. You might not have the true data, but you can sort of extrapolate. So you must learn that art of extrapolating. So if there are 1 million youths in Nigeria and there are 5,000 schools and you have X number of people between the ages of 15 and 20, you can extrapolate some sort of data. You have to be good at extrapolating data. You also need to look at similar companies and so one of the things I tell people is find out similar companies in your field and request for their pitch deck. So sometimes they have the data you're looking for. They have it. Some of them have already spent on that data and you can get it from them. So go out and look for similar companies, look for their pitch decks, talk to the founders. A lot of people actually divulge information when you speak to them. You're not necessarily saying, give me this thing, because the minute you come to them, like, give me this information, they probably will not want to give it because they also spent time, resources, and effort trying to get that data. But there's a way you can approach someone that the person is kind of open to sharing with you. Then talk to industry experts too. They can always give you a summary or an overview of this. And that's why at the beginning of the slide, I told everyone that you need to build relationships. You cannot have all the data you want at this stage, but if you can extrapolate and then lean on the understanding of the market, on other people's understanding of the market, you're going to be better placed than somebody that doesn't do all these things.
Guys, ask questions. Wow, you don't have, it looks like you already have money, you don't need any funding.
Like, it's only Michael that.
Serious? Uwem, do you believe this?
No, the thing about this is a lot of times people realize they have questions at the end of the class. You know, when you go back and think about everything you heard, you now begin you realize that, oh, I do have questions to ask.
Please ask questions. Guys, this is our last class. So what that means is you're going to leave you, and the next time we meet, you're going to be doing a test run, right, of how the demo day is going to be, and that will determine if you're even going to pitch.
Yeah.
So if you have questions, this is the right person. He has been interfacing with startups and listening to startups pitch to him and tell him their multi-billion idea, right? Ask him whatever you want to ask. Let him correct you now so that on that day you go into, should I say you go before people and you know what you're saying.
Okay, so just as they're thinking about the questions, let me give you a more holistic list of due diligence questions that most investors ask. So if you can take notes, you should take notes. So we look to see if you have a clear revenue model. So is there a path to profitability? Do we know what you're selling clear? We need to look to see if you have identified your customer. So your ideal customer, your target market. We look to see if you have achieved product market fit. For early stage company like yours, it's a journey, but we need to see that you're already out there validating your market demand. We look to see if you have a low cash burn, especially in these Corona times. If the money you're spending on running the business is more than the business is making, then it's sort of like a red flag for us. We look to see the team, a complete team, that you have the requisite skill to build the company. And if it's a tech company, you have at least one technical co-founder. We look to see that, yes, which is something I forgot to mention earlier, that you are mitigating regulatory risks. Doing business in Nigeria is a risk on its own. The government comes up with new policies here and there. So what steps are you taking to mitigate the risk, potential risk? There's risk in every sector. So what are you doing to mitigate the potential risk? Is there an exit or liquidity potential? So for every investor, we also want to exit over time. So if you want to show the investor that if they invest in your company now, in the next 5 years, you're going to make enough money, or your company is going to be more valuable than it is now, so that they can exit and make money. How are you investing? Investing is also a two-way street. How are you benefiting the investor? So Investing Capital recently invested in a Kenyan payment company. And one of the benefits we saw was that it was an entrance into the Kenyan market for us. And immediately the founder sold it to us. In short,
Hello.
Yeah. Hello.
I'm sorry, I have to take it back. I have to take it back again.
Okay.
Could you repeat what you said? Yeah, right from the beginning. We lost you there again. For some reason,
wow, I think
network is crappy here.
Okay,
Really
so
sorry.
first one, clear revenue model. What exactly are you selling? What is the pricing of what you're selling? Is it profitable? Will it be profitable over time? Clear business model. Is there a clear business model? Like, what exactly is your business structured as? Is it a platform as a service? Is it a B2B? Is it a B2C? It has to be clear to us. Have you identified your customers? Have you done a proper target market analysis? Are you achieving product market fit? Because at the early stage, you probably will not have product market fit. So are you working on achieving that? Are you validating the market demand? You need to show us data that you have gone out to validate that people really need your product or service. People are really going to use your product or service. Even if it's an idea, you must have already been validating it. We look at cash flow. Not cash flow, burn rate. Like, is there a low cash burn rate? It's very important in these Corona times. If the cost of production is way higher than how much your business is going to be making, then it's a red flag. So we want to see that there's a low cash burn rate and that there's a path to profitability. So if you adjust your pricing, where are you going to be profitable in X number of months, right? If you reduce your cost of production, is there a way you'll be profitable in the near future, right? We need to see a path to profitability. We also need to see your team is complete. Remember how I said that your team will have complementary skills. They must have the skill sets to build the business. And if you're building a technical product, you must have at least one technical co-founder. What is the size of the market you're targeting? For Ingressive Capital, we say we are targeting $1 billion market because, say see one of our investment, Paystack. Paystack is a potential $1 billion company because of the market they're targeting. Are you taking steps to mitigate regulatory risks? Doing business in Nigeria is a risk on its own. The government comes up with all sorts of policies. A very good example is OPE. They did not take the risk of the Lagos State. They didn't take it that serious. That the Lagos State government will come one day and say, hey, we don't want you to operate again. That's a big regulatory risk. For fintech platforms, they're looking at CBN because CBN protects the banks over innovation. So what steps are you taking to mitigate the risk? If CBN changes their policy today, are you already thinking ahead on how you will survive? A good example is piggy bank. CBN changed their policy to say anybody that's going to hold money or you must have a microfinance license. Piggy bank had to have a in short, they had to first change their name from piggy bank to piggyvest and then get a microfinance license. So are you thinking about, if you're a health product, are you thinking about what do they call the health organization in Nigeria, whatever, what they're saying regarding verification of doctors and all that? We must see that you have thought about the risks that are involved in doing that business. We also look at your exit potential. Every investor invests to exit one day. And when I mean exit, they want to make money, right? So if you can show me that in the next 5 years, your company is going to be worth times 10 of what it is now. In the next 10 years, it's going to be worth way more. Then I would most likely invest in your company. Now, investors are looking for feel-good factor. Feel-good factor because there's now the SDG goals. So how is your business bringing positive impacts? Because at the end of the day, the investors will also ride on that. So is business creating more jobs? Is your business creating wealth? Sell that or show that to the investor, because that's one of the things investors look out for. Can the investment return fund? So like I said, venture capitalists or venture VCs take money from LPs, limited partners, and reinvest the money into other startups. So can it return the money that was given to us over time? Then we want to see that the founder or the founding team can demonstrate grit or perseverance. So, and that's why we look at your history. Where have you worked in? Which is why, as a sidebar, as a side comment, I tell people, be careful not to just jump into starting your own business. It's good to work for somebody, build your portfolio, build your experience, so that when people are doing a background check on you, they are seeing all the things, all the great things you have done previously, in the previous startup, in the previous company, working under somebody. We also want to see that gives us trust. That helps us trust you more. I know I mentioned that cap table is clean, so we want to see that those that invested, the other people that invested in your company, and if the structure is kind of clean and clear. I don't know how many of you heard about the WeWork saga and how they created shell companies to get investment and all that. If people are taking a second look at their cap table, they would have seen that things were not as they seem. To ensure that we are not investing in Yoruba. Yoruba will say it's basic in problems. We also want to see that the founders, and this is back to team, have known themselves for more than 6 months. People say it's weird for people to, so you might think it is weird, but it's not weird. The longer people have worked with themselves, the longer we think that partnership will last when money is injected. So we want to see that you've known, at least the core team have known each other for quite a while. We also want to see that the market is ready. So timing of your product, is the market ready for this product or service? And this is different per VC, because some VCs like to work, some VCs work with Blue Ocean, that they work with the Blue Ocean. So they were looking for companies that are first to market and all. But some VCs are very careful because the Blue Ocean takes time to become profitable. In short, it takes a long time to become profitable. Amazon took years to reach where it was today. Now, so it doesn't mean that the early stage investors didn't make money, but they lost money, a lot of money at first before they made money. So we also look at, is the product ready for the market? And then technical defensibility, which is why I told you that we even try to use product or service if it's good. So can you actually, when we put your product or service under scrutiny, would it live up to the hype? Would it live up to the hype? If you are writing a software code, if we give it to a product expert or a technical expert, will it make sense? Then what is your competitive advantage? Like, this is such a big deal. What makes you stand out from all the competition? And do not ever make the mistake of thinking your product or service or company doesn't have a competition. There is a competition in the market. It might not be like for like, it might not be direct, but there is always something competing for you, for the attention of your target market. So what is the unique competitive advantage? And can it be copied by anybody? Can it be easily copied by anybody? And then on the lighter side, we look to see if there is a female co-founder on the team. We also look to see if there is an indigenous co-founder. So indigenous co-founder in the sense that how will I put this now? And this is a case of, let me use the Kenyan ecosystem as it. So in Kenya, you have quite a lot of European people settled in Kenya to start businesses. Now, one of the things we will look at to say is, hey, yes, you're European. Yes, you bring a lot of experience. You built X business in Italy, but you want to build this business in Kenya. Do you have a local on your team? Because that indigenous person brings the perspective of the local economy to you. So we want to see that you're not just doing business based on how you see, but you're doing business based on how the local people see your business. So we want to see that there's an indigenous person part of your team. So yeah, those are some of the things that people look out for, or investors generally look out for.
Thank you, sir.
We have two questions. What is the investment threshold for Ingressive? One, and two, what is your outlook in terms of exit time?
Okay. So it has changed, and partly because we're trying to give startups the best chance to succeed. Now, before we had various thresholds. So if your company was valued at, say, 500K, we'll give you a $20,000 ticket. If your company is valued at 1 million, we'll give you 50,000. But we've changed all that now. And we've said we're going to be giving ticket sizes for up to about $400,000. But there's a caveat. We will want to own at least 10% of the company. Now, for different VCs, ventures platform, microtraction, they have different. So microtraction likes to play at the pre-seed stage, so where you are just building your MVP. So your ticket sizes are smaller. However, they are open to giving, they are faster to write out checks compared to an Ingressive capital because people are at different sides of the spectrum.
So okay.
Yeah.
Go ahead.
Then for exits, we typically do not look to exit, and we've not actually exited any company. We do not look to exit any company till the company gets to a Series B. And the only company that we have invested that's close to that right now is a Paystack. And in short, we don't even look to exit till you have returned the funds times 10.
Okay, so you're looking at 10x.
Yeah, well, in short, we're looking at anything higher than 10x.
Got you. Okay. Yeah. Okay, great. So have you been a lead or part of a syndicate? So
we've played on both sides now, because our philosophy is we do that initial investment as a lead or as a syndicate. Then for your follow-on, we like to do a follow-on invest. We now form a syndicate with other guys to do a follow-on. So if we see that your company is doing pretty well, we actually go out and look for other investors to invest in you. So everybody wants to be the lead because you take the terms, right? But it's not always happen that way. But where we have the potential of being the lead, of course, we'll be the lead. I mean, the lead is basically putting in more money than everybody.
Perfect. I hope the class understands the question that I was asking. In case if you don't, please ask. I am using terms that may or may not be familiar to some of you. Ask them if you don't understand the question.
Hey guys, Toby, Zook, Simon.
Sir, as a startup right now, like where we all are, which is like we're not in market yet and all. What metrics do you think are key for us to focus on in the early days of operation?
So very first thing is, very first advice I'll say, avoid vanity metrics. Now, vanity metrics are things that do not lead, they are nice to have, but they don't necessarily tell you about growth, or they cannot be converted into anything tangible. So say, for example, you have a dating app. I'm using examples here. A vanity metrics will be number of downloads, because your number of downloads is not going to tell you, it's not telling you how many people have paid. It's not telling you. So yes, so avoid vanity metrics. Now that takes me to the next point. Figure out what are the most important metrics for your business.
Mm-hmm.
Important metrics, it differs, it depends on what business you're looking at, what industry. So it could be daily average users, it could be monthly average users, it could be churn. So how many people use your platform and stopped using your platform over time? It could be how many people are paying, converting over time, right? So you need to determine what are the most important metrics for you that will bring you money at the end of the day.
Yes, sir.
So then you use that. I can't necessarily tell you what
Yeah,
metrics.
depending on the sector.
Yeah, it depends on the sector, what's most important. And you know, the funniest thing also depends on mostly on the stage of your growth. Now for OPay, let me use OPay example. At that time where they were, giving out free rides and all, and doing and getting people to, yes, I get people to use the bike platform. For them at that point in time, the most important metrics was numbers. And so they were trying to amass the numbers.
Yes,
They're trying to amass all the data. But over time, I'm sure that has changed. The metrics will now be maybe number of transactions done so over at different stages of your startup, different metrics are important to you.
Okay. All right. Thank you, sir.
You're welcome.
Please go ahead.
Come close.
Yeah. Or project.
For investments or delayed investments your company has made, does it have a defined time of exits? Does it have to be the 10x strategy, or is it like based on
every VC likes to, every VC looks at 10x.
10x?
Because yes, every VC looks at basis 10x, because you need to return the funds that we're giving to you, and you also have to make money.
Okay.
So every VC looks to make money.
Okay, then is there after the 10x, is there a reduction of equity in the process?
No, not really. So once, we've had situations where founders actually buy back their equity over time, right? We've actually had situations where VCs buy out other VCs over time. But it's a case by case basis. Nobody reduces their equity except that you give them a good reason for that. So you're either buying it off them, you're buying their shares in your company, or maybe your company failed and they're leaving the company. But nobody gives up ownership just like that.
Just an addition to that, the only way that equity will go down is if you also go for another round.
Yeah.
If you do that, then obviously there will be dilution.
Yeah.
So if that happens, then whatever the percentage of amount that you raised and the valuation of the company, and if you're lucky at the time the valuation is high, yes, the equity will still go down, but in terms of, like he said in his earlier slide, your constant in terms of the dollar value might go up, but the actual equity will go down. Yeah, because that will be dilution. Uwem, would you agree with that?
Yes, I do. You're spot on.
Guys, do we have questions about our business now? That means you're ready, right?
As you have lots of we have a lot of time.
We're ready for 2010. Guys, ask. So we are
It's well.
it is well. Hey God. Hey, you guys should ask questions. If I was you, I would do like a demo for him now about my pitch, right? How it will look on that day and ask him for input.
Okay. So, well done, Mr. Oh. Hello, sir.
Yeah, I can hear you. Go on.
Yes, like for my own case now, we've been, not that we didn't make sales during the COVID, but it wasn't as much as before the COVID. So this should also reflect. So it means the curve will come down, and I don't think will it be interesting? I don't know.
So we all know that, I mean, all around the world, everybody has seen the impact of COVID. The interesting thing that we all thought would happen is that people will stop investing, or investments will dry up. But interestingly, people are actually still taking bets on companies this period. So if you can show potential for growth, in short, if you're pitching to anybody, you must have a deck, a side that has a comment for your post-COVID plans or your COVID plans. You must capture it. So we need to see what your plans are post-COVID and how you intend to you intend to bounce back, or the changes you have made in your business to accommodate the pandemic, so that you're still surviving and doing business. We would definitely invest in you if we find it interesting.
Interesting. Okay. All right.
Well, general question again. Are you particular in terms of what segment you're investing in, or you invest in, or you're open to all fields?
We're actually open to all fields, but this technology part has to be, core to your business. So your business must be heavily leveraging on technology.
Okay. Guys, because some of you are not really technology driven. Well, you're technology driven, but your core market is general market. So I was expecting this question, and that was what I kept asking. Some of you really are the regular businesses, but technology will help you. So if you have any question in that space, and you're all asking, well, how do I make money, or how do I get money to fund my company? So here's a guy who can help you, and you're not asking questions.
Thank you already.
Or maybe you already are good.
Obviously. All right.
So they can always reach out to me. Yeah, with questions.
Thank you so much.
Yeah.
That was really helpful. Thank you.
You're welcome.
Thank you, guys, Michael.
Thank you, sir.
Yeah. So thank you very much, Uwem. So I'll be sending you an invite for the demo day, which is on the 23rd. I already told you the people that will be part of that session. It's just going to be a 2 hours thing, and then they pitch for 3 minutes, and we select one person, basically. So thank you very much for all your support. Really appreciate it.
You're welcome.
We're expecting that when you're coming that day, you're not coming as a facilitator, but also as an investor.
Actually, you're coming as an investor.
Yes.
Let's see how that goes.
Okay. Thank you very much.
Right. Thank you all
for your time. Really appreciate it.
Thank you. Thank you. Guys, so now we need to have the talk. How's our preparations for the 23rd? Yeah, Monday, next week, Monday.
Personally, just
we're preparing.
Just trying to simplify the pitch to make sure it fits in that 3-minute slot. Because I can remember the last pitches we all did, I think maybe a handful of us actually got to finish our pitch. So I think it's trying to streamline it to make sure we get all the facts we need in it and being short, clear, and precise. I think that's what I'm working on right now.
Okay, he's going to send me his slides and I'll send them to you. However, remember what he said on the slide I had preparing the pitch and all that. You're not supposed to tell us everything, no? It's the information that would actually pique people's interest that we need to hear.
right? You can't come and tell me everything about your business in 3 minutes. I don't think that's possible, right? But you could give us the things that you know that, okay, when I say there's this investor or these people will be interested and want to ask me questions further, that will then pique people's interest, and then you can now go and start telling stories and all of that. But for 3 minutes, you do not have time to beat around the bush. I remember during the boot camp, Dr. Mohammed will cut you short and tell you, please, you're wasting time. Nobody cares. Go straight to the point. It's really, really important, right? And for the 23rd, we have Mr. Bukar Kari. He has already accepted as former chairman of Nigeria Economic Summit Group. He's also the CEO of Trans Corporation, I think. Yes, Trans Corporation. Yeah, you can look at him on Bloomberg. Trans-Saharan Corporation, you can look at him on Bloomberg. We also have Yemi Kari joining us.
Oh, geez.
Yes, she has accepted. She sent her photo. We have the SA to the Vice President on Innovation, Mr. Ife Adebayo, joining us also. And then we have the CEO of Layer 3, Diko, joining us. And now we have someone from Ingressive Capital, right?
So,
yes, ma'am.
For the ladies online, not that I want to sound sexist here, but Yemi Carey, her outfit, which is an investment firm, I think is Arise Africa, something like that.
Yeah, Arise
They're
Africa.
very particular in investing in women ventures. So if you guys, and one of the things about presentation is really try to know the people, and just now a message telling you who are coming. Try to go and check out those people so that you can even tailor your pitch to those guys so that at least you can get people's interest or you can pick their interest. Like I think it was Fahad or somebody that mentioned something like try to find out the background of those people that are coming for your pitch. So the more you can do that, the more chances you will have in getting people interested in what you're saying. So.
Also, guys, so Monday, the 20th of July, we'll be having the test run.
Okay.
Physically or via Zoom?
No, via Zoom. So we are doing it virtually because most of these people are not even in Abuja.
Yeah, most
right?
are in Lagos.
Are in Lagos. So we are doing it virtually, and I know that during the sessions, most of us, we still stay in our houses and all that. If you know that you don't have network in your place, like for me now, where I stay, I don't have MTN. I only have a Tisalat network, right? And there are times I need to take certain calls with my Tisalat. I have to go upstairs. Please look for a convenient place to do the test run because you're going to be pitching on Monday. So what time would you be available? Shall we do this time?
We could do 10 o'clock.
Okay, so 10 o'clock. So 10 to 12, normal time. So 3 minutes, you're going to pitch, you're going to present. What that means is you're going to be projecting your slides and all of that. You're going to be seeing everything, right? And this will determine if you're going to pitch on the 23rd. So if you need to look for a co-working space, I don't know if Abdul Latif is here, not sure. If you need to look for a co-working space to go stay, he's not here. You need to look for a co-working space to go stay where you can hear, where you can really talk and and the background is fine and there are no noises and all of that. Please do that. Because on that day, you're going to be projecting, not this one now, you can be on the phone, you can be on a bike, and you just have to mute your mic. We need to see your face when you're talking.
And very important, you cannot do this on your phone. You have to get a laptop. I know some of you are still using phone to do all this. You really, like she said, need to project it as well as people need to see your face.
All right.
All right, so.
All right, so Monday, 10 o'clock, I would send you the link. Please, I know I'm not supposed to say it, but I think it's important, right? Guys, please dress properly. We can only see your upper body, but we need to see you looking at least good, right? Yeah. If you're even saying, oh, I want to be hippie and I want to wear my t-shirt for pay up, I want to wear my t-shirt for Toby Links, it's fine, but really look presentable.
Let
Yes,
your
ma'am.
background be as professional or as cool as possible.
Yes, ma'am.
All these little things matter because we cannot see you, we cannot see your body language, but we can look at what we are seeing on the screen is what is going to help us, right? Your presentation is part of it. Remember what we did the last time. We are still using the same metrics. So we are doing impact. We are looking at impact. We're looking at the presentation itself. We're looking at scalability. We're looking at, let me just check. I think I have everything. Yeah, so I will send it to you, but it's the same metrics, right? The standard metrics that most investors use to check people out. And then we are bringing people that will be asking you more questions based on their own thing. While we are, this phase of the program or this cohort is not, we're not investing in you per se, but we're also looking at you and seeing who we're going to continue our relationship with.
Yes, ma'am.
So it's really important.
Okay.
I'm going to send you the link to link to the folder containing all the videos and all of that. Please look at it. If there's anything you want me to do to support this, please ask questions. Send me a message and just tell me what you need. If it's not yet to be done, I will do it right away. Right, guys?
Yes, ma'am.
One thing that I promised you is founder agreement. I have it on my computer at home. I need to check it. I'll get that ready for you. Yeah. Okay.
Thank you, sir.
Can some of us usually come here on that?
Yes.
How do we, the issue, how do we project? Remember the last time we were having issues capturing them. Well, let's still be facing
But
this.
you can come here and there's some other one do it on your computer.
Yeah, you
You
can do
use the
that.
network here.
You can do that.
From another. Okay.
Yes, you can do that.
Yeah.
Right. What else?
For those of you in Abuja who are having network problem, you can come here and take advantage of that. Stay in a room and project it from your computer, and then we can see it. How about that?
Yes, sir.
Okay, sir. Thank you, sir.
Is there any other question you want to ask now? This is for us now. Uwem is no longer here.
Why did you call me?
I didn't call you.
That's why you need to get away from home.
Is there any question you want to ask, please? So please, guys, just to recap, I think I said this last week, but I'm saying it again. Everything that has been done from value proposition up till today, please reuse those things to make your pitch, your presentation better, right? He said a lot about your valuation and all of that. What I think he said it, but then remember, if you now have the wrong data, and these people we are bringing, they are actually industry experts. You now come and tell us the addressable market is so and so, and call one number that nobody understands. You are going to be put on the spot, and no one is going to take you seriously when they find out you lied. Right? So get the right number. There's a problem with data. However, what you can do is when you get a data, let's say you get a data from the UN or you get data from maybe World Bank or something, put the source. So we know, because most times they even don't get their data correct. But so we can know that this data is coming from me and you've done a bit of research, right? Please know your numbers. The valuation, the revenue and the financial modeling class we had last was really important. I sent everyone the documents. Please do that so you can know what you're asking for.
Yes, ma'am.
Be prepared to ask. Yes, we are saying we are not giving, but you have other people coming, right? Please ask, have an ask, but then let it make sense.
As a guide for the ask, you are not going to say, I want X amount of Naira because that is how much I need for the entire period for my company to be profitable. No, it doesn't work that way. You want a certain amount that would run you through probably a year or two before you go out. That's why there are all these series of fundraising. The moment you close, because that's the problem that you guys will face, assuming you find yourself in that luxurious position of even raising the money, however difficult that it might be. The moment you close your first deal, as the CEO, you're actually on the road thinking of the next round, while you're at the same time building the product that you collected the money for. So as a CEO, it's no fun, honestly. Once you collected the money, you are really working hard and you'll be judged on the money you just collected, but at the same time, you know that money is not enough for you to go to profitability. So you start thinking for your next round and how you're going to plan that. So at the same time, you have to be driving 3 different cars. How you use that money that you raised, how you're going to actually use it, or rather maintain the company and continue hiring and scaling. And then lastly, making sure that you are preparing yourself for the next round. So it just continues. So it's a game. But it's a very, well, I don't want to sound negative on this, but it's a very stressful game. At the same time, it's fun. So have fun with this. See you on Monday.
Thank you, sir. Thank you, ma'am.
Thank you, sir.
Let me send him a message now. All right, now, thank you. See you on Monday. Let me send him a message.
Hi.
Bye.
Lola was there?
Yeah, she was there. So you
I mean, sir, I was in.
Yeah, I know. Because you have not been attending the early parts, now it looks like you're really getting in the groove, as they say. So it's good.
Yes, I was in, but I didn't have questions. But I know when I go back, I would have questions then. So
Well, he has already opened the floor for you guys to reach out to him. So if you have questions, you can always ask.
okay, guys. Bye.
bye. Bye.
How long have they been in business?